Here at Bob's Tools, we depend on the accounting cycle to manage our business. Today, we'll be taking you through each of the accounting cycle steps to make your business a better success. The accounting cycle consists of 8 steps. One of the first parts of the accounting cycle that we use is the journal entry. The journal entry is an entry to the journal. It holds a record that keeps accounting transactions in chronological order, also known as how they occur. A ledger account is an account or record used to sort and store balance sheet and income statement transactions. Examples of general ledger accounts include the asset accounts such as cash, accounts receivable, inventory, investments, land, equipment. Examples of the general ledger liability accounts include notes payable, accounts payable, accrued expenses payable, and customer deposits. An unadjusted trial balance is the listing of general ledger account balances at the end of a reporting period, before any adjusting entries are made to the balances to create financial statements. The unadjusted trial balance is used as the starting point for analyzing account balances and making adjusting entries. Adjusting entries are journal entries made at the end of the accounting period to allocate revenue and expenses to the period in which they are applicable. An adjusting journal entry is typically made just prior to issuing a company's financial statements. An adjusted trial balance is a listing of all the account titles and balances contained in the general ledger after the adjusting entries for an accounting period have been posted to the accounts. The adjusted trial balance is an internal document and is not a financial statement. The purpose of the adjusted trial balance is to be certain that the total amount of debit balances in the general ledger equals the total amount of credit balances. For the financial statement, I wanted to show you what a real one looked like, and this is a perfect example from Amazon. A financial statement, or a financial report, is a formal record of the financial activities and position of a business, person, or other entity. Relevant financial information is presented in a structured manner and in a form easy to understand. Closing entries are journal entries made at the end of an accounting period which transfer the balances of temporary accounts to permanent records. Closing entries are based on the account balances in an adjusted trial balance. Temporary accounts include revenue, income, and gain accounts, expense and loss accounts, dividend drawings or withdrawal accounts, and income summary accounts. We are now at the last step of the accounting cycle. This will end our journey to getting you to a better business. A post-closing trial balance is a list of balances of ledger accounts prepared after closing entries have been passed and posted to the ledger accounts. Since the closing entries transfer the balances of temporary accounts to the retained earnings account, the new balances of temporary accounts are zero, and therefore they are not listed on a post-closing trial balance. However, all the other accounts have non-negative balances are listed, including the retained earnings account. This is Bob's Tools, and I just wanted to say, thanks for watching. Good luck with your business.